In less than 2 weeks, the Modi government will announce its final budget for this term. Technically, it's a vote on account, but indications are the government may still make a match of it. Every year before the budget, CNBC TV18 brings you a bunch of the top fund managers in our series, What the World Wants from India. We kickstart this series with one of the most seasoned India watchers, Lucy McDonald, Portfolio Manager and Chief Investment Officer, Global Equities with Alliance Global Investors. Lucy, thank you very much indeed for joining us. I want to straight away delve into India, but since you have a global perspective, first that. Will this be a good year for global equities, and how will it be for emerging markets?
We're imagining a year of relatively flat returns, but more volatility. And that's really what our expectation was for last year. And the reason why we're thinking that is because we are starting off with liquidity being drained from the system because of rising interest rates and also QE. Mm-hmm. And also that growth will be slower this year because we're coming off a year when you've had very strong earnings growth in the US. And then also, although we've had some derating in valuations, they're still at the high end of history. So overall, that suggests to us you're going to get quite a flat year. Within that, emerging markets look to have a bit more potential upside, we think. Okay. And India has been a bit of a bastion of stability over the last year. So that's the overall picture we're looking for.
Okay. India, bastion of stability. The earnings have not really delivered. Will that be a showstopper, or do you think that this year the earnings will indeed deliver?
It looks as if the probability is higher that the earnings in India deliver this year, and particularly with the financial sector, looks like that could be a source of upside this year and into next. So in a relative sense, where we're seeing earnings downward revisions elsewhere in the world, it could look better placed. Okay.
Well, since you start with financials, let me get to the budget itself. Do you really watch out? Will you watch out for this budget very seriously? There is a lot of noise that there will be, populist giveaways before the big general election.
Yes, I think it's the election which is really the focus for foreign investors, and the budget, clearly is going to be in the run-up to that, and likely to be a boost because of that. But it's really the outcome of the election which is going to be of interest.
Oh, really? Will it make a big difference if there is a non-NDA government, a non-BJP government?
Well, it may not make a big difference to the overall growth picture over the medium term. That tends to be, pretty well, set by the fiscal settings and the monetary environment. But that it does affect the rating that foreign investors are prepared to put on the earnings. There is definitely a perception that a stronger government is going to help more with reform and continue the strong growth that's been seen in India.
So clearly, as a stock market investor, you would want the BJP government to return with at least a majority, even if not a similar majority.
I think on balance, investors and commentators tend to prefer, a cleaner and stronger government.
Okay. Well, before I get to the elections itself, how crucial is the budget? If it had a large farm giveaway, will that, a large farm package, will that worry you? Will it stop you from making any investments for a bit?
No, I mean, the assumption is going to be that there will be fiscal loosening, ahead of the election. That's normally the case. It would be surprising if it wasn't.
Okay. Well, in the meanwhile, at the moment, you said that, earnings may finally deliver now. What are you incrementally buying or interested in India?
Well, the financials I mentioned should be in a better place as far as, credit cycle and provisioning is concerned. That's one area. And then technology. So within technology, there's still quite good, strong demand for services, for digital transformation services. All of that is very helpful for the sector. Against that, there could be some more concerns about margin because of visa issues in the US. But I think the overall backdrop is still quite strong for those services, and it's structural growth.
Okay, but I'm more interested in financials. Which part of financials do you like? Like everyone, you just like the private retail banks?
Yes, I mean, it does look as if the banks themselves could be, because of that provisioning and credit cycle, could definitely have a better earnings trajectory over the next 2 years.
Okay. No, but what about the non-banks? I mean, they went through a bad patch late last year. Some of them seem to have emerged out of it. Are there pickings there?
There probably are. There's still quite good structural growth in asset management, wealth management. So fee-based services is going to be a good growth area, we think.
Okay. And when you say wealth managers, would you also include other things like insurance companies, for instance?
Yes, and those fee-based, as I say, that seems to us to be where you can get some good stability and visibility of earnings.
Okay. Well, let me move away from finance and infotech. It appeared that a nascent capex cycle has started when you looked at Larsen & Toubro's numbers last quarter. Does that space interest you?
Yes, over the medium term, the infrastructure is a good growth area. I think at the moment, the capex seems to be relatively stable. It's not accelerating, so it's not an obvious sort of cyclical place to be.
Mm-hmm. A couple of years back, or maybe 3 years back, Pharma was the big one that we were watching. At the time of the 2015 Chinese yuan devaluation and all that chaos, Pharma stood out, but it has since only fallen. Anything in that fallen angel space?
I think it's always an interesting area. Regulation and price regulation for pharma, I think everywhere in the world is an issue.
Yes.
And that obviously then goes down the line to generics. So within pharma, it really, we have to focus globally on really innovative areas. That's the only place where you're going to get pricing power.
Anything outside this space? I mean, pizza suppliers or specialty restaurants or, clothing makers, branded clothing makers like Page Industries or Avenue Supermart that saw such fancy valuations. What is it in the mid-cap space that interests you?
Well, we don't really look too much into mid-cap in India. Being global investors, we have very concentrated portfolios globally. So within India, we won't really be going down that deep as global investors.
What are you expecting on the interest rate front? Do you think that the Reserve Bank has room to cut rates because inflation has fallen? Or do you think it'll just worry about the fisc and so interest rate is not a big game to play now?
Well, the overall picture for inflation, the core inflation is around 4. Headline is lower than that, so it looks as if there could be scope to cut, but really that core inflation is what matters. So I don't think there's a huge amount of scope to cut. And really the fact that the oil price has been weak has helped with that. Yes. And helped keep inflation lower than it would otherwise have been. So I don't think there's a huge scope for cutting.
Okay, and a final question to you. What's the big risk out of India?
I think probably it is the potential for overheating. And so the risk that all investors have been focused on has been the change of leadership at the bank. The RBI, and I think that still seems to me to be the biggest risk. Underlying there's good structural growth. The political situation is relatively stable. The inflation picture is more or less under control. But that the risk seems to me of excessive monetary stimulus, because we've seen that happen in the past. But if that is kept under control, then I think the medium term looks pretty rosy.
Well, that's an important comment, saying that they're not terribly worried about earnings or about the structural growth story, but worried about the change of guard at the central bank and whether that could lead to overheating, excessive monetary stimulus. That's a warning which we should keep on board. Lucy McDonald, it's always a pleasure speaking with you. Thank you very much for joining us on this first episode of What the World Wants from India.
Thank you very much.
We take a break, but thereafter, don't go away. We are getting yet another star fund manager, Julian Mayo of FII Capital, to speak about what he expects. Welcome back to our special series, What the World Wants from India. The series where we speak with veteran foreign fund managers who have been long watching Indian markets. My guest now is Julian Mayo of FII Capital. Julian has been a watcher of and an investor in emerging markets and in India for over 3 decades now. Julian Mayo, thank you very much for joining us. Well, first up, first the World Bank and now the IMF have been bringing down the global growth forecasts for 2019. Generally, do you think equities is the place to be in 2019, or do you think smart money will perhaps find equities less rewarding in 2019?
I think one has to differentiate a little bit between developed and emerging markets. I think the developed market, bull market, if you like, is slightly long in the tooth, and I think is running out of steam. Whereas from the emerging market perspective, the markets obviously had a bad year last year. They had 5 bad years up until 2016, and so actually I think emerging markets are relatively well positioned for 2019, based on really a recovery in valuations and a gradual recovery in their economies.
Let me then concentrate only on emerging markets. It's good to hear that things will be better for this side of the world. But right now we are seeing China reporting its slowest pace of growth in 28 years, we are told. Will not that affect emerging markets growth in general?
I think it will to some extent, although the thing is that the China economy is growing bigger every year, admittedly by a smaller amount. So it's growing 6.5% at the moment, but it means that the base is rising the whole time. So the impetus that China can give to the rest of the world continues to be very strong. And I think that applies to a lot of emerging markets.
All right. So in that case, what's your pecking order in emerging markets on the equity side?
That's a very good question. I think China and India feature very highly in that. So we have our biggest overweights in our global emerging markets portfolios are in China and India for different reasons. As you said, the Chinese economy is slowing down, but nonetheless is continuing to grow at a healthy 6+% growth rate. India is growing at an even faster growth rate of between 7 and 8% on a longer term basis. So those are the 2 markets really at the top of our pecking order. Other than that, you're talking about some of the other faster growing economies such as Indonesia and also areas where there is an economic recovery going on from a low base, such as Brazil.
Okay, well, let me come then straight away to India. Do you get disappointed by the fact that Indian corporate earnings growth has not fired for 4 or 5 years now?
Yeah, I think that's the biggest concern we have as bottom-up stock pickers in India, is being able to find stocks where there is that growth dynamic and where you are seeing very strong growth. And so I think, for example, the consumer staple sector, which is obviously has been a sort of favourite for investors for a long time, we don't see a huge amount of growth there, and from a bottom line perspective, we've been disappointed by that. There are areas of the market where growth rate is strong and where we are seeing the kind of double-digit growth rates that one would expect from a high-growth economy like India.
Which are those areas?
Well, the financials would be an example. So we see continuous growth in some of the big private banks. So we own, we like HDFC Bank, we own Kotak Mahindra and Indiabulls Housing Finance, which is a slightly different business, but nonetheless, we think we see growth in the financial sector there, but also in some of the more, if you like, structural stories. Container Corp of India, which is obviously a rapidly growing long-term case as the whole kind of dedicated freight corridor,
Yes.
It comes into place and expands over time. And also, we have a position in an agrochemicals business called UPL, which is obviously participating in the longer-term growth dynamic of agricultural chemicals. That's a low-cost producer, and obviously, as the world becomes wealthier, it needs more protein.
Fair point. It's tempting to go on with questions. Go on with stocks, but I'm interested in your political worries as well. So first, let me come to that. Would you worry that India is going through polls, a general election, and the outcome might disturb the earnings cycle?
To some extent. I mean, normally I'm very enthusiastic about countries that go to the polls. I think democracy is a good thing generally, and I think governance is a key driver of economic prosperity. And but certainly it seems to us that the reforms that the Modi government has put into place over time are going to start bearing fruit. I think that the key thing, obviously the key, if you like, vulnerability with India economically from a macro perspective is its budget situation, and certainly what needs to happen is that the take of government revenues as a percentage of GDP needs to rise over time, and I think that's probably what's going to happen. But I also think we're at a situation now where a lot of the heavy lifting and all the difficult work has been done in terms of the GST in particular. And the impression we get is that, although we're not political analysts per se, is that whatever happens in the election, the forthcoming election, whoever wins the election is going to continue with this broad reformist programme, because ultimately the budget deficit necessitates it.
Okay. Well, actually, that was the real reason for inviting you. There will be a budget in less than 2 weeks. It usually is a vote on account, but this government has kind of hinted that it will announce some kind of a farm program, and there are all-round fears that that might increase the fiscal deficit more than what the bond market can stomach. Is that a worry at all for you?
Yes, I suppose it would be. I mean, we're not sort of privy to the kind of political minutiae that you are in Mumbai or your colleagues are in Delhi, but nonetheless, it seems that would be a concern for us. But again, I think you need to differentiate a little bit between the short and the longer term. And whilst there may be some sort of handouts, if you like, in the run up to the election, I think it's over the longer term, the commitment to narrowing that deficit, I think, is going to continue.
No, more generally, you're not worried about the fact that there is a slightly less respect for things like fiscal deficit, slightly less respect for central banks and their capital and their inmates. Are these, broad institutional questions a worry for you at all?
Yes, I mean that's a very good question, because obviously the quality of institutions, the institutional framework is critical, and often in emerging markets we've been very critical of countries that are where central banking has been too politicised, where central bank policy has been far too loose, and I think Turkey recently over the last 18 months has been a very good example of that. I almost think in India it's gone too much the other way, however. I think that the central bank has been a little bit too hawkish. Okay. And actually what was required was a little bit more flexibility, which we now have.
All right, good. I'm sure the government's very glad to hear that. Okay, therefore, if there is going to be, some kind of fiscal largesse, would you worry that we could get higher interest rates? One of the big arguments is that, as you said, the government, the central bank has been too hawkish. Are you expecting rate cuts, and therefore will that inform the way you pick stocks?
No, I don't think there's going to be a big movement in the interest rate environment in India, and particularly for the reasons you mentioned earlier. If there is a bit of a fiscal laxity in the short term, that'll obviously put upward pressure on rates at the same time when, fundamentally perhaps rates should be being reduced. So I don't see there being significant movement either way in rates over the shortish term.
Okay, fine. Let me come to the sectors and stocks that you mentioned. You began with private banks, and then you said you also like some of the non-bank companies, housing finance companies. I think you had at some point taken interest in Indiabulls Housing as well. would you continue to persist with non-bank finance companies, especially because they went through a bit of a turmoil in the debt markets last year?
They did, although I think a lot of them were unfairly, sold off by association with obviously the bigger concern with IL and FS.
Yeah.
But I think that Indiabulls Housing Finance, for example, has made some very clear statements about its liquidity position,
yes,
about and its longer-term growth trajectory. So we're not the least concerned about that.
Okay. All right. Which other sectors other than private banks and NBFCs would you take a look at? Public sector banks or corporate facing banks like ICICI and Axis? One argument is that now their period of bad loans is behind them.
Yeah, we would look at the private sector banks in general. We like the governance of the private sector banks as a whole. As I said, we've made our choices, and we're happy with the ones that we own at the moment. But we look throughout the sector. I mean, as for this balance between, consumption or consumer-facing banks and industrial-facing banks, that is something that we look at the whole time. Over time, as India develops, obviously there's growth has got to come from both sides of that, and banks have one of the, if you like, structural problems with India compared with some of the Asian, the Far Eastern markets is that the savings rate and therefore the investment rate is lower than it should be, and obviously if that rises over time, there's an increased participation in banks, lending both to the consumer sector and also to the industrial sector.
Okay. Finally, what about IT and Pharma, the global-facing sectors? A couple of IT numbers were excellent, the third quarter numbers.
Yeah, I think they're both areas that we look at. We are probably not as keen as on Pharma, okay, as we are in some of the IT sectors. But certainly IT is an area that we do look at. It's on our radar screen. We look very closely at it. Okay.
Well, this is a pre-budget interview. What, according to you, is the biggest risk that you look out for in India?
Well, I guess in a broad sense, populism, I guess, would be the way to characterise it. It's the concern that we would have across the world, and by the way, more so I think in the West than it is in emerging markets at the moment. Is this descent towards populism and therefore its effect on short-term policy making. What we need to see is long-term vision, and I think that's what the government has really been demonstrating over the last 4 years or so in India. So I think it's really what we'd be concerned about is an excessive focus on short-term considerations, and what we're looking for is as I said, is a longer-term vision.
Okay. Well, just a final question. If, for whatever reason, the current BJP government is not returned to power after the May elections, would that change your outlook on India? Would you buy less, more?
Well, I think it depends really on the manifestos and the statements that come out after the election from whoever who obviously takes power. But as I said, our view is that the reforms are of a nature that the opposition would also, in a broad sense, carry into office when they take, if and when they were to win the election. So we would really look at what the incoming government says and respond accordingly. But I don't see any reason at the moment to be pulling a lever and to say let's reduce significantly our position in India. But by contrast, I'd be minded in the longer term to increase further our positions in India.
Julian Mayo, it was a pleasure speaking with you. We do hope we can speak with you yet again after the budget and definitely after the elections as well.
Thanks.
Well, that's Julian Mayo of Fairer Capital, and the key takeaways: likes private banks and NBFCs, which he thinks are unfairly targeted. Also likes Indian infotech, and not terribly worried about elections, definitely worried about populism. Well, that's the first of our What the World Wants series. We will be back with more in just a few days.